I think America has been heading in the wrong direction. Everything is overpriced. The stock market is overvalued about 8%. The system is built delivering us junk products at increasing costs just so they can keep the rich rich. Many of your guests, and mine also, have said that we're headed into a stock market crash. All this stuff is, I think, is getting ready to come to a head.
There's no way out of this predicament without pain. It's gonna take real pain and real sacrifice. There is no magic pill that all of a sudden makes everything better tomorrow. We're gonna have to pay the piper. Is Wall Street and or Main Street ready for this? Are they prepared for this type of pain? And the answer to that is a completely unanimous no. And we as a populace, we don't want to elect politicians who are selling short-term pain to us. Trump has a bold set of proposals. Things like we're gonna deport millions of illegal immigrants. We're gonna use the threat of tariffs. There's some tax proposals, things like that. Can he be successful in those without some pretty notable material short-term pain in the economy? Disruption comes along with a lot of breaking things. To make an omelet, you gotta break a lot of eggs. Trump looks like he's gonna break an egg truck full of eggs.
Adam, welcome back to our show.
It's such a pleasure to be here, Todd. Thanks so much for inviting me back on.
You bet. The last time that you and I spoke, we said that we would talk after the election. So here we are.
You're a man of your word. Thank you.
So you interview guests on the economy, the stocks, stock market, finance all of the time. Many of your guests, and mine also, have said that we're headed into a stock market crash. But, after Trump, and I want to pull it up here too, because after Trump was elected, the S&P has hit this new high, over 6,000. Adam, what is going on with this?
Well, markets, obviously, two things. One, markets love certainty, or you could look at it the other way. They don't like uncertainty, right? So they generally de-risk going into an election, especially one that looks like it's going to be as tight as this one looked like it was going to be. So people kind of get out of the pool for a little bit just to, sit in safety to see what happens after the dust settles. And then once they know who's been elected and they know what policies to position for, markets sort of re-risk again. So that's part of what's going on. I would say in general, Wall Street is probably more likely to react more positively to a Trump win than a Harris win. So I think we're seeing this too. The market's basically saying, okay, regulation's going to be reduced and Trump's going to be spending more to stimulate the economy than Harris likely would have. And so I think you're getting all that priced in here. There are some other things going on too, like we had the buyback window just open, and there are going to be more buybacks done this quarter. The more expected buybacks this quarter than I think at any other quarter in history so far of the markets. So you have that massive wave of buyback capital coming back into the market as well. And of course, a lot of people are saying, well, how much more can the sugar high run? We'll talk about that, Todd, but it could run longer than people think for a variety of reasons. But certainly as we get closer to the end of the year, you've heard of the Santa Claus rally. That's driven by oftentimes just programmatic things that either have to happen in terms of portfolio rebalancing and things like that. And of course, everybody's window dressing at the end of the year to try to make sure that at the snapshot on December 31st, they're owning the stocks that did really well this year. And that tends to add additional buying pressure. So there's a lot of things going on in the mix there, but it's no huge surprise that the markets are running right now.
Explain the buyback window for those that don't know what that is.
Sure. So companies can, if they have excess cash, they need to decide what to do with it, and they can either invest it into future operations of the company, or they can return it to shareholders. And, people are probably familiar with dividends. Dividends are one common way for companies to return excess cash to shareholders. But another thing they can do is they can buy back their stock. And what that does is reduce the outstanding number of shares of the company. And, in theory, Todd, that should kind of be a neutral event. You're taking some money out of the stock, and you're reducing the outstanding flow to the company, and therefore you have a little bit of a smaller pie over a smaller number of shares, and the value per share in theory should be what it was before. But that's not really what happens in practice. In practice, for a variety of reasons, the market tends to interpret that as a positive development for the company because future earnings per share go up because there are fewer shares that those earnings are going to be shared amongst. And so anyways, the algorithms and the way the Wall Street machine is set up right now tends to interpret that positively. Now, there are a lot of problems people have with buybacks, and I would put myself in this camp. In theory, if you are running a company, what you choose to do with your excess cash, what you choose to invest it in, should be the absolute best use of that cash, right? If it made more sense to build another factory or whatever, you should be doing that to grow shareholder value. So when your company is buying back its shares, it's essentially saying, we've looked at the universe of everything else in the world that we could do with this money. And we've decided that the number one best investment in this is to buy back our shares. In practice, when they're buying back shares, they're not buying back shares from the general shareholder class. If you and I own shares of Apple and Apple does a share buyback, they're not knocking on our door and saying, hey, Todd, can I buy your shares? What they're doing is they're buying those shares from corporate insiders who have big, equity positions, option positions, and they're looking to liquidate those. So it actually is it's favoritism to those corporate insiders, many of whom are, their incentives are based upon, how the stock performs. And so this is, in some ways, people look at this as stock price manipulation. That, hey, we're buying back our shares. We know that's going to boost the price of the shares. We as insiders have all these incentives that are tied to how the shares perform, so we can drive the direction of the share price in ways that'll trigger our equity value, and we have the company buying. We know we can unload our shares to the company directly. So there's a lot of people that don't like this, and it is hard to a certain extent not to see share buybacks as market manipulation. When you look at the net amount of buying that's been done in shares in the market over the past decade, a tremendous percentage of it comes from stock buybacks. And not for nothing, Todd, they used to be illegal. But it's one of those things that got walked back, and it is so beneficial for corporate insiders that nobody wants to get rid of it, obviously. And shareholders are somewhat, we're quiescent in this. I don't think we should be, but we are, because in general, they've been driving share prices up. So if I own shares in Apple and they're doing buybacks and the share price goes up, I feel like, hey, what's wrong with that? I'm making more money on paper. But in reality, it really is, in my opinion, it's a wealth transfer from the existing shareholder base to the small number of corporate insiders who are basically selling their shares back to the company.
Interesting. So when you see people like Warren Buffett liquidating, hundreds of billions of dollars in shares, I mean, what kind of an indication, and I believe that this was before the election too, correct me if I'm wrong, but what is that indicating?
Okay. So, these are related but different things. So, I mentioned how stocks ran up post-election, and that's not a huge surprise right now, right? But stocks are incredibly overvalued right now. And I've got a couple of charts I can show you, and we can get into some of the metrics that explain why. But this is an indicator of how expensive stocks are, which is that Warren Buffett, who has made a boatload of capital in companies like Apple, is now starting to liquidate those positions in mass. Right? He's been famously not buying things for a good while now. I think he's been a net seller. Berkshire's been a net seller of equities in the past 8 consecutive quarters. So as stocks have continued marching higher, and their valuations have been getting more and more stretched to the upside, Warren Buffett has said, look, this is too rich for my blood. I'm starting to get out of the market here. So he's been, making some pretty big portfolio reductions. I think he's now sold over 2/3 of his position in Apple as measured from its height. And he's been doing similar with Bank of America. But the other thing he's done, and this goes back to buybacks, is Berkshire has been a big buyer back of its own shares for many years. And Warren Buffett has recently stopped doing that. And he has been on record saying he's in favor of stock buybacks. And his logic is If you can buy back your own stock at an attractive discount, like if you know your company really well and you think the market is undervaluing it, yeah, then maybe you're one of the best people to step in and buy your stock there because you really understand the future's prospects of your company and you're going to buy something on sale, right? He's basically saying Berkshire's way too rich, right along with every other stock. And so it's just not a good value right now. Okay, so this is a ratio of the market cap of the S&P 500 versus world GDP. Now, you've heard of the term the Buffett ratio, which is essentially a PE for the stock market. So that is the market cap of all U.S. stocks versus the U.S. GDP. And that chart looks similar to this one, which is that's over 200% for the first time ever, pretty much right now. So as a sort of national PE ratio, stocks have never been as expensive as they are right now in the U.S. Now, this chart compares the S&P 500 market cap to world GDP, not US GDP, but to world GDP. And you'll see here, it's approaching 50%, again, for the first time ever. So you kind of need to think of this as like a global PE ratio. And it has never been this high. The only two times it was anywhere close was the beginning of 2022, and we all know what happened that year, and going into 2000, and we all know what happened that year in the markets. So, just a very easy finger to the wind calculation here that shows that stocks are much richer than they've really ever been. So if you're going to be long this market, then you have to ask yourself, okay, what's different about this time, right? Extremes are called extremes for a reason because they revert, right? So, that chart I just showed, when we were back at previous, even lower extremes, the market then went through a pretty painful reversion. You have to ask yourself, if you're going to be sitting fully long right now, okay, what's different about this time if you think we're going to avoid some sort of reversion?
Well, I can tell you there's a lot different, in my opinion, and I want to cover some things here because, Adam, we have never been, at least in my lifetime, I think our lifetime, where everything is overpriced. So I want to kind of go over, I want to talk about, a lot of these economists say that the stock market is overvalued about 8%. And I mean, you could argue, split hairs, whatever, but that's a big number. And at least, the current stock market, meaning that the stock price to earnings, like you just described, is out of equilibrium. It doesn't make sense, right? Right? Based on what they produce, what they profit, what they can return. So a lot of different reasons for this. Number one, they want to keep the rich, right? I mean, so they have to, if these earnings weren't so out of whack, now it's the backside of it is these corporations need to find ways to deliver the profits that they're promising, the dividends that you spoke of, or being able to have the money to buy back their own stock or build other factories or what have you, because the demand is much greater on them. All the while, and I want to dive into this, but we're building less superior products than we ever have. We're building junk. I mean, it's trash. It's a lot of the consumer goods are garbage. We've offshored the manufacturing, so that has hurt us from like the 1970s into the 1980s, and as a result, and we're going to compare this. If you take products and adjust for inflation, we're about to see where everything's overpriced. And the reason, in my opinion, it's overpriced is to continue this stock market rally. The Fed backs it to keep these prices elevated so that shareholders, which are the few, not the many, we've discussed this. It's one of the reasons why you want to try and educate the way you do is to get more people investing, ordinary people investing, because only the wealthy are the ones that are playing in this arena. And so the system is built delivering us junk products, bad food products, all this stuff I think is getting ready to come to a head.
At increasing cost.
At increasing cost, just so they can deliver the profits. And I'm going to prove my point here. But before we do, I want to ask you, I mean, obviously Trump is going to be the president of the United States come January 20th, what types of occurrences? You just said we're overpriced in the stock market. I think many people believe that to be true. What types of occurrences? We see 6,000, over 6,000 today. What kinds of events could happen that would bring this crumbling down?
Yeah. So I get asked that question all the time, and I think the answer is there's certainly a lot of candidates out there that we could talk about. It could be a collapse in consumer spending, it could be trouble in the bond market. I mean, it could be a lot of different things. But in most cases, it's the bullet that you don't see that gets you. And if it is sort of a black swan event, by definition, it'll be something that you and I aren't going to come up with now in this conversation. Because if we could name it, then it wouldn't be a black swan anymore. But there is, there are studies they've done where you're dropping grains of sand into a pile, right? And the more grains of sand that you drop onto the pile, the higher the pile gets, the steeper its sides get. And then at some point you start having these slumps, these sort of little mini avalanches, right? And they've done all this, fancy computer modeling, and they can't predict which the grain of sand that's going to cause the collapse of the pile. But what they can predict is as each individual, incremental new grain of sand goes on the pile, they can calculate the collapse risk. Like, okay, it's getting higher. Okay, now it's extreme. And usually pretty soon it slumps down, right? And I think that's sort of the way to look at this system we have here, which is, look, there's a bunch of risks out there. We're probably not going to be able to pinpoint with absolute certainty how this thing's going to go down, but we can look at the collection of risks and determine if collapse risk or correction risk is high, medium, or low. And I'll be honest, that's really what I try to do at my at thoughtfulmoney.com is I interview all these different people, and I try to get all this data and all these different data points, and I try to get a sense for like, okay, is if everybody is warning about risk, then that gives me a sense that threat level is pretty high, right? I'll tell you right now, in the short term, people are pretty not worried. And by short term, I mean like rest of this year, starting into next year, so I don't see many people saying it's all going down tomorrow. I do see a lot of people, who like Danielle Park, who I just interviewed, who's that was her chart of, market cap to GDP I just showed, who are saying, hey, look, there's a lot of stuff to worry about, and we got to really keep our eye on this. To the spirit of your point, though, if I had to pick one thing, if I had to pick the bullet that could take this down, I'd probably go with Michael Howell. Michael Howell started his career at Salomon Brothers. Very smart guys, very data driven. He's been kind of Mr. Liquidity. One of the things that I think has been the most directly responsible for this just sort of resurgence of stock prices since the 2022 correction has been net positive liquidity flows. This is just capital continuing to flow into the market that has to get reinvested every month. That flipped positive in October of 2022, which is really right when Michael Howell said, hey, everybody, I'm beginning to feel really bullish about the future. And it's because he tracks global liquidity flows so closely. And he has been bullish ever since. So I just interviewed him recently. And the reason why he's been bullish ever since is because, his model has these net liquidity cycles that are multi-year. And he's been saying, look, my model says liquidity is going to keep rising, and therefore I'm bullish still. So I interviewed him, and he said, he put up his chart of the cycle, which continues through 2025. It kind of peaks right at the end of 2025. And he said, I still think stock prices are going to go up from here for a while because of this rising net liquidity. But he said two really important things. He said, one is the impulse of that rise is going to be slowing as we get through 2025. Just like when you throw a ball up in the air, right? It starts to slow right before it hits its apex, and then it starts coming down. So we're in that slowing process as we're getting close to the apex. So he said that's going to likely by itself make 2025 not as a barn burner of a year as 2024 or 2023. But then he said the thing we really have to watch out for is the wall of corporate debt refinancings that we're finally really beginning to get into the meat of starting in 2025. So Todd, you and I probably talked about this about a year ago. It was in the headlines a year ago, which is, hey, Fed's pursuing higher for longer interest rate program. The cost of debt is much higher than it was just a couple of years before. And you have all these corporations that have low yield, low cost debt on their balance sheets that's going to come up for maturity. They're going to have to go out and basically refinance that debt at substantially higher rates, like maybe even 2x or more than the current price of the debt on their balance sheet. And everybody was, worried about that, but it kind of just went away. It fell out of the headlines, and to a certain extent, it was kind of out of sight, out of mind. Well, we're now getting to that point in the story where those refinancings are really starting to happen at scale. And yes, the Fed is starting to reduce interest rates, but it's doing, relatively slowly. The difference between a 5.25% federal funds rate and a 4.5% is not tremendously different, right? And as we'll probably talk about in a bit, even though the Fed has started cutting its benchmark rate, bond yields on the longer end of the curve have actually gone up since the Fed started this. So debt's actually become more expensive. When you're a company and you're out there borrowing new debt, you're not borrowing at the federal funds rate, you're borrowing at prime plus something. So in many cases, companies that are going out to refinance now are facing an environment where that debt is 2x more expensive, maybe even more. So Michael has said that that's going to start happening with like a rolling thunder in 2025. And that is going to act like a giant sponge, sucking that liquidity out of the market. So that's going to be going on with increasing intensity through 2025. And then at the end of the year, we hit the peak of the liquidity cycle, and it's going to switch to contraction. And then we're going to have several years of contracting net global liquidity. So he's basically said, look, I think the markets will probably be up in 2025, but it's going to be disappointing because everybody's now used to these, gangbuster years of returns we've had. And he said, I don't even want to think about 2026. That could be a really ugly year.
Yeah. So a couple things that I was thinking about, which really goes to Michael's point, is interest rates. So obviously rising interest rates could be detrimental to these corporations and really take a hit in their liquidity for sure. But I think inflation as well. Inflation probably wouldn't be good but it's kind of interesting. I say that, but then that defies what we experienced happening with high inflation and the stock market rallying. So, what are your thoughts on that? How does inflation impact stock prices?
Okay. So, inflation will impact stock prices. In general, it will hurt them. It should hurt them. But it will direct capital to companies that should be able to outgrow inflation, right? And that's why tech and the Magnificent Seven have done so well over the past bunch of years, because people have said, oh, inflation's becoming an issue. I got to put my money in something that's going to outgrow inflation. And that's one of the reasons why they've hoovered up such a massive amount of every new dollar entering into the market. But in general, higher inflation would lead to higher interest rates because the Fed wouldn't be able to cut as much, and it might have to raise rates again to cool off the economy to combat that inflation. In theory, that would bring economic growth down and eventually share prices down. I'll tell you, Todd, I interview all these people just like you do. And on most issues, I can say, there's kind of a general consensus. 2/3 of the people I interview, no matter their approach, think X is going to happen. Inflation and the future of interest rates / bond yields is like split down the middle right now. This is one of those things that really explain why we have markets where we can have really smart people look at the same data and come up with very different conclusions. You get kind of the Lacey Hunts, the Luke Gromans of the world who look at, either the shrinkage we've had in the money supply or the knock-on effects, the lag effects that they feel, we're still going to experience from the higher for longer regime we've been through. some of the just natural constraints on economic growth that the economy is going to face going forward. And they are very much in the like, oh no, disinflation is going to be in charge for a good while. In fact, we might need to have to worry about deflation. And then you have folks on the other side of the equation who are much more concerned that inflation is sticky, not going to go away. There are some structural things going on in the economy and supply chains, geopolitically, that are going to keep inflation sticky, and that the bond market is increasingly going to lose faith in the Fed's ability to contain it. And I think it's too early to say this personally, but that's what some people are saying right now when they're pointing to how the long end of bond yields has risen, even though the Fed has started to cut, where they're saying, look, the danger when you're in an era of fiscal dominance for as long as we've been in is that eventually the market begins to lose faith in the central planner's ability to solve things. And as Bill Fleckenstein likes to say, that you get a risk of the bond market taking the printing press away from the Fed, where it starts raising yields and impedes the Fed's ability to do the type of rescue efforts that we've all become so accustomed to.
Well, I guess that is, I think that speaks in volumes, because a lot of people, Ron Paul's been saying it, I think, for years, but he's recently come out saying we need to end the Federal Reserve. And it's interesting because, as you know, a mutual friend of ours, Danielle DiMartino Booth, I just flew to Dallas and interviewed her face to face. And what we kind of spoke about, or what she was talking about, was how closely connected the Federal Reserve is to Wall Street. And, they're bankers, right? They're central bankers. And how Greenspan really introduced this, this ability for the Fed to manipulate these markets, the stock market, to keep the stock market up, right? To keep it running.
And I want to Fed put, yeah.
Yeah, and I want to pull up a couple interesting, because that really got me thinking. And I'm a simple kind of guy. I swung a hammer for years. I'm not, the necessarily the sharpest tool in the shed. But it got me thinking, Adam, that I started thinking to myself, like, let's take a look at this inflation stuff in the first place. So I want to pull up this inflation calculator and get your opinion on a couple things.
Sure.
And so I've already loaded in here 1985 and 2024. But have you seen this calculator? Have you probably used something similar before, right?
I've seen inflation calculators before. I don't know if I've used this one before.
All right. Back in 1985, the Big Mac meal was $2.59. Okay. If we use this inflation calculator, which is to calculate, and this is all based on, the government CPI data. All right. Mm-hmm. But if we go back 1985, the cost of Big Mac meal was $2.59 on average. If we calculate for inflation today, it would be $7.59. The average in America is actually $9.29. So to the point here of a Big Mac meal, that's 22% more than it should be. And the case I'm building here gets back to the way that we started here, how the stock market is only concerned about delivering record profits to its shareholders, keeping stock prices high, and delivering the millions and billions of dollars to C-suite executives that run these companies, right? They make so much money. And as a result, we know that, they're using products that are bad for us. And so we're not getting a more quality hamburger. Some would argue we're getting a lot of, processed foods and things. So, and a lot of cheaper products, but just stay with me here. So what I did here was I also said in 1985, a dozen of eggs. Do you have any idea how much a dozen eggs was in 1985? All right, 75 cents.
Okay.
On average. That should make a dozen eggs today. And I'm going to drop the link to this calculator if you guys want to play around with it. But a dozen eggs today, their average price in America is $3.82. And this is grade A large eggs. That's a 74% increase in what it should be inflation adjusted. So again, when we're looking at these numbers, right, I want people to understand this calculator is adjusting for inflation. And one more example that I want to use, which is staggering. I'll ask you again, any idea of what a median home price was in 1985?
$85,000.
$84,300. Great job. All right. So that means that today, adjusting for inflation, it should be $247,024.85. Guess what? Today, the median home price is actually $420,400 on a nationwide average. That's 69% higher than inflation adjusted pricing.
Right.
So what the hell?
Yeah. This is why nobody believes the CPI, right? And that's what people call the CP lie, right? Because there's been so many revisions to how the government officially calculates inflation that it's become totally divorced from what people experience in real lives. You know, all the hedonic adjustments and all that type of stuff, right? So yeah, it's maddening.
I mean, so it seems clear to me that what needs to happen is that this inflated product market needs to come down. I mean, we and if we really and this leads to the bigger question, because obviously, and I don't look, guys, this is not a political show. Adam and I, we don't really talk politics. We give our personal opinions, and I think Adam, you would agree with me on this. The bottom line is Donald Trump is the president, will be the president of the United States for 4 more years. And, you know, whether you're happy about that, sad about that, whatever, it doesn't matter. It is what it is what it is. But the point that and Adam, what I have to ask here is what can be done? I mean, so if somebody says, all right, well, we're going to reduce taxation or double taxation or, you know, that doesn't seem like, of course, everybody wants reduced taxes, but what we really need is deflation.
Right. Yes, we want deflation in most things. We don't want deflation necessarily in our assets if we are counting on those assets.
How do you do it without?
We also don't.
How do you?
We
do
also
it without?
don't want deflation that's so strong. Well, let me get there. So we don't want to have deflation that's so strong that consumer spending and corporate profits get so compromised that companies do mass layoffs, right? You might be all on the deflation train until you lose your job, right? And then you're like, well, I'm shafted at this point, right? Now, the point is, it's a big question you're asking, Todd. And the simple answer is there's no way out of this predicament without pain, right? The question is, you know, can we take the smart pain, right? Like, can we really take the medicine we need and emerge, you know, in a much better place after we've paid the price that we need to pay? Or are we going to get, you know, are we going to choose bad pain where, you know, we end up with, in a worse situation and, you know, we've maybe done some things in the near term to try to cushion the worst of the blows, but we've traded off, you know, a long-term, even greater wealth transfer or, you know, whatever. But, you know, that's the process that we've been pursuing for the past, 50, 60 years is just the can kicking. We don't want to take the immediate pain today. We don't, and we as a populace, like we don't want to elect politicians who are selling short-term pain to us, right? We need to get to that point where you can have a credible candidate come up and say, look, I've heard you, this all isn't working for you. We need to take this hard medicine here. You're going to have a couple hard years, but we're going to go through it collectively as a nation. And then here's how we're going to get to a better side. And this is an important point I was meaning to bring up. So you're giving me a good opening for it, which is, as you said, Trump has just won the election. Trump has a bold set of proposals that he's put out there. Things like, you know, we're gonna deport, you know, millions of illegal immigrants. We're going to use the threat of tariffs to try to get nations to do more of what we want. He's got some stimulus spending that we've talked about. There's some tax proposals, things like that. And an important question I asked this weekend is, and again, this isn't a pro or anti-Trump comment. It's just, let's assume he's successful in those, right? Can he be successful in those without some pretty notable material short-term pain in the economy, right? Like, can you deport millions of people who are currently working? And so you're at least initially losing / displacing those jobs. Those jobs are likely at lower wages, lower benefits, obviously, than you would have to pay a domestic citizen to work. So, that's going to impact corporate profits. Now, you might say, look, it's for the right long-term goal. Totally get it. But my question is can you do that? Can you win a tariff war without imposing tariffs for a period of time and, forcing consumers to pay more and reducing consumer spending, and therefore that has knock-on effects in the economy? You might win the war in the end and be in a much better position after a couple of years of this. But again, probably likely you're going to take some pretty short-term material pain in the economy. So sort of asked two questions. I said, can we do it without, this short-term pain? And I think most people answering the question was like, well, no, we're really going to have to take that short-term pain. Okay. And I can definitely see the logic of that might be the right trade-off to make. My next question was, is Wall Street and or Main Street ready for this? Are they prepared for this type of pain? And the answer to that is a completely unanimous no. Right? Wall Street is priced for better, whatever better for perfection is. That's what Wall Street's currently priced for. Mainstream's just trying to hang on by its fingernails, and I think is feeling, at the majority, pretty optimistic now about the economy going forward because they just voted for a candidate that they, basically promised them better economic times. But nobody's really had this adult discussion yet with the country that says, look, if we want to be successful in this stuff, we're going to have to tighten our belts. It's not going to be a painless ride between now and then. And I think that is a big wake-up call coming. And to your earlier question, that could be something that creates a pretty dramatic repricing in the financial markets. If we start having that adult discussion, or even if we don't, but we start feeling that pain because it's the cost of where we want to go, once the market wakes up to that, it's going to say, wait a minute, I got to reprice my economic growth assumptions because they're way too rosy.
I think that's all very well said. I mean, you just talk about housing, the housing industry, and inflation. I don't know what the exact numbers are, but it's probably somewhere about 33% of all construction workers are probably non-U.S. born migrant workers. Now, I'm not saying that they're all illegal, but I will say that how do you deport all of these positions? That's a valid question. And I want to get into this because the last time we spoke, and I have some comments that I want to go over, you brought up about how we have about 100 million working age Americans in this country that are jobless for whatever reasons. But before we get to that,
let me just correct that stat real quick.
Okay, go ahead.
It's over 100 million adult Americans that are considered outside of the labor force. Now, a good chunk of them are too old to work. Some of them are college students. The problematic cohort that you're talking about is over 10 million-ish or so, which are able-bodied working age adults who are just choosing not to work.
Got it.
Yeah.
All right. So I want to pull back the inflation chart because to get to this point, I want to kind of just go over minimum wage in the country. Mm-hmm. We do have some manufacturing here in the U.S. still, and 5 of the states that are the largest in manufacturing, and I want to talk about that too. But if we talk about minimum wage, I want to go back, keep it consistent with 1985. Mm-hmm. In 1985, the minimum wage, Adam, was $3.35 an hour. If we calculate that based on the same calculations, we would be at $9.82 per hour for minimum wage. Mm-hmm. The federal minimum wage in the United States is still $7.25 per hour. Now, to be fair, I understand that's not where you are in California and a lot of states. The states have increased the minimum wage. But of the manufacturing and getting back to the Wall Street numbers, the big corporations, the ones that have offshored manufacturing to save money, they've taken our customer service offshore. They've taken our administrative work offshore. All for profits to lower the cost of doing business, to increase
Ross Perot's
profits.
giant sucking sound. Yep.
Yes. 5 states in the U.S. that do the largest amount of manufacturing or have the largest amount of manufacturing companies and jobs are Texas, Pennsylvania, Indiana, Wisconsin, and North Carolina. And wouldn't you know it, Adam? Every one of those states, the minimum wage is still stuck at $7.25 per hour. Now, I'm not saying that these workers are making that, but isn't that interesting that some of the states that are doing the most manufacturing, have the most manufacturing jobs, are still at $7.25 an hour?
So is it surprising that the average customer has seen rampant inflation in everything that they need to buy to exist, but that the big employers have seen the least inflation, right? Those that have control and reap the benefits of corporate profits have been able to enjoy the least inflation in labor costs. Yeah, no, sadly, I'm not surprised by that.
Let's talk about the jobs, because I think, look, I would love to say I don't think anybody can rightfully say, and the numbers spoke for themselves, that they are happy with the way the economy has been the last 4 years. And you can point your finger in whatever direction that you want. I think America has been heading in the wrong direction, right? We know, and for many, many reasons, but one is being explained of why we have 6,000 in the S&P, right? These corporations are profiting madly on consumers. Consumers have to say no.
I mean, at the end of the day, right? If you think, and I agree with you, right, that this trajectory we're on is unsustainable, right, because it is creating a wealth divide that is getting to levels where 10 million people are checking out of even the system entirely, right, who should be contributing to it. We're at record levels of unaffordability for homes, and the younger generations not only don't think they're going to be as wealthy as their parents were at similar age, but they've given up on major life milestones like owning a home, owning a car, getting married, having kids, right? That's reflected in the plummeting birth rate in this country. So that can't continue forever, right? And this is sometimes on my channel, I'll ask the guest, like, do you worry at times that we might hit a social boiling over point before we hit the financial boiling over point, where it's really a social revolution or a social crisis versus a financial crisis? So yeah, no, I agree with you that look, at some point this is going to have to break. Now, look, I do want to say, look, I'm a huge fan of capitalism, right? So I'm not recommending a socialist agenda here. I do think that what we have right now is much more like corporatism, which is sort of ruling by the corporate elite, right? Which has reinvested its advantage over the decades into financing and funding politicians in DC, who then write the laws and regulations that then increase the advantage for the big corporations. I mean, it's hard to find, we've talked about this in the past. It's hard to name an industry, a corporate industry, that isn't more or less run like a cartel with a few really big companies at the top. And then it's just really hard for anybody to challenge them going forward. We've all seen the revolving door in DC, right? Where legislators and regulators, once they're done on DC, they go get a really fat board seat, with the companies that they were overseeing, right? So I think we talked about this before. Like, there are people who think, look, there's a master plan, and there's a very few that have their spider web that goes out and is running the world to their grand plan. I don't really believe that, but I think we kind of end up at the same stage anyways, where we just have players that have gotten an unfair advantage, and then they've continued to invest that unfair advantage to gaining even more advantage. And over time, you kind of end up in the same place where you have a few people who control all the assets and all the power, and everybody else is increasingly marginalized. So, sorry if I went on a rant there, but I agree with you. Like that can't continue forever. Now, the question is, what's going to cause people to rise up and start demanding reform? I mean, maybe the good news,
they may have started.
It may have
that
started.
May have
right?
started last week.
Exactly. I'm not saying necessarily Trump is the savior, But what I am saying is very clear is the number one reason why people said they voted the way they did is because they thought the country was on the wrong track.
Let me ask you a question, Adam. You know, we were really founded on, you said it, capitalism. But part of that was opportunity, which in a lot of ways we don't have because of the heavy handed corporations that have put so much regulation in the system that you can't compete with them. I mean, the only way that you can compete is to have deep pockets, you know, shareholders and favoritism with the people that are in charge. I mean, that's the system that we've built. What if Trump were to come in and do something? Don't worry about the corporations that have taken their businesses offshore. You know what? Goodbye. You did that. We're not going to beg you to come back, incentivize you to come back. What we're going to do is we are going to triumph small business in America once again. We are going to incentivize right here in our land for our youth, for our intelligent people that know how to do things with resources to develop manufacturing onshore to compete with these people and these corporations. Would that work? You know, to say, you know what, we're going to bring a better product to America. We can do it. We can onshore it. We can bring these resources here in the U.S. and we can do it in a way that won't cost a fortune to get it done. And they can go toe to toe with these big corporations that would rather make their products in China.
Yeah. So I'm with you on spirit. I think it's possible. I think it would be really messy. And I think there'd be, a huge amount of fight back from the system that would have to be overcome. So, whoever is doing this would have to have like a really clear public mandate to get it done. And I'm not quite sure we're at that stage yet. Because where I'm going with this is there would be a lot of pain to make this happen in the initial years. And this might be a decade plus long endeavor, right? And, in many cases, I'm all for reshoring industry and things like that. But, to your point about inflation, a lot of that's going to be inflationary. Like we'll pay a higher price. An American just
would
can't.
We? I mean, would we? If you really look at it, I mean, why? If they were to come in, just like they did post-World War, they cut red tape. World War II, post-World War II, they cut red tape. They encouraged manufacturing. They encouraged home building. What would it take? I mean,
what's different? Yeah.
Cut the red tape.
There's a ton of red tape to cut. So don't take anything I'm saying as I'm opposing this at all. I'm just saying it would be really disruptive and painful in a way that we would have to be fully bought in to get through all the pain to get to the other side. And as I was saying earlier, like an American is just not going to be able to afford to live on a salary that a Bangladeshi, is willing to accept. Right. So just things would cost more.
Well, the corporations wouldn't have to pay billions of dollars to their C-suite executives.
Yeah. Well, I mean, look, like I said, there's so much I think that can be cut and improved on the current system here. The key thing is I'm going to go back to a question you asked earlier, Todd, which was, what can be done about inflation? Right. And the simple answer to it is one, we can stop monkeying around with all the things that artificially cause inflation, right? Like the interventions, the trillions in stimulus, that we never should have spent at the levels that we did. So we have to stop all of that. We got to get the Fed and the fiscal side of the house out of deforming the system with all the, money and liquidity, the stimulus that they're pumping in there. But the long-term way to deal with inflation is to grow faster than it, right? So is to build an efficient economy that grows real value and American household income faster than the rate of inflation, right? That's what pulls us all out of this. So, if we can get to a point where we are doing that and we are truly investing in, the engines of American growth, and we're sourcing and nurturing that growth here, within our borders, rather than, driving growth in another country, maybe even a country that's not even a great fan of America. The great bargain that we struck with China, America's been responsible for China's rise because we were the folks that were sending all the money their way by buying their products, right? So if we can get through all that, I think, yes, like I said, I think there's a way to get where you want to go. We're just going to have to be prepared for it, be willing to accept higher prices, sluggish economic growth, some pretty disruptive changes, especially as, maybe some of these big companies, lay off in America, but then slowly get rehired as new, better competitors come into play. The one thing I just want to mention here that's going to be rough, we're going to really have to figure out in this process is, I'm holding up a book here. It's Jim Rickards' new book, which is basically all about the AI threat. So Todd, I'm actually interviewing him as soon as I'm done here with you interviewing me. So I don't have Jim's feedback yet, but I have long shared this fear too, which is there's a concept that's been well known in economics for well over a century called technological displacement, which says, look, if you can replace human labor with technology that does a better job or even the same job but more efficiently, you should do that. But you have to be careful at the rate at which you displace the human labor, because if you're displacing it faster than you're finding a productive new use for it, you end up creating a social cost that oftentimes is bigger than the efficiencies you gain from the new technology. So, it's really hard to look at things like AI as a potential big job killer. And look, I mean, if you're one of these mega corporations that's heavily investing in AI right now, I mean, your hope there is I want as few humans as possible to employ, right? They're expensive, they're litigious, right?
Again, a lot of this is the system that has been built. If you allow a lot of the shenanigans, now I'm not saying that things shouldn't be litigious in certain aspects when you're talking about discrimination and basically enslavement of employees. I'm not talking about that, but I think we have allowed so much more than that. The regulations, the requirements, the overburdening. This is the cost that make it conducive to operating or wanting to operate a business. I mean, it's common sense. We need to get rid of a lot of this insanity. We need to get back to the basics of humanity. I think that we need to have more farmers, more local-based farming. We need to have more manufacturers. People are smart. They have brains. They can make things. We can do things on a local business level, but in order to compete with this, somebody at the government level needs to say, look, we need to back off on a lot of this stuff. We need to get more competition, make things more competitive, and give people good jobs, create and generate good jobs in doing so. This AI, you want to talk about frustrating. Call up any corporation that you need to deal with, whether it's the local cable company, the utility company, and I'm not
if
knocking.
they have a phone number anymore.
That is true. And I'm not knocking or trying to degrade or insult or, in any way, fashion, say that people in Bangladesh aren't as important as the United States people. That's not my point. Call around. Find out how it takes 5 minutes on average to even speak to somebody after you press every button possible. If you think AI is going to make this better when it can develop or deliver incorrect data, wrong information, you want to talk about frustration. We got to get back to some sanity here, man. This is, again, I believe this is all coming from big Wall Street business that is trying to keep the stock market engine alive by reducing costs as much as they can for the betterment of their shareholders and the C-suite executives that are running these corporations. This is all interconnected. This is not better for the the American people.
No, I would totally agree. And again, that's why I sort of used that term corporatism earlier. Like I think that is more or less what we have here. And look, what we're going to need, right, is real disruption, which is essentially what you're asking for here, right? And I think way too early to really tell, but I think this is one of the things that has really appealed to people about Trump's platform that he's put forth. And I will give Trump high marks since winning the election. I don't know if you've been seeing these daily videos that he's been putting out, where he's, picking an issue like, free speech or immigration or whatever, and just banging out, okay, these are what my proposals are going to be on day one, right? So he's definitely walking the talk right now of translating what he said on the campaign stump to, okay, these are the things I'm going to do in my first, 24 hours of office. And a lot of it, is promising disruption. I think that's what America was looking for. Like I said, disruption comes along with a lot of breaking things, and there's going to be a lot of short-term pain that we're going to have to deal with. And I don't necessarily think we've prepared America for that yet. Do I think it's the right thing? Absolutely. Just so I can put my personal bias on there. But it's, to make an omelet, you got to break a lot of eggs. Trump looks like he's going to break, an egg truck full of eggs to get this stuff done. But I do, to your point, like, that's the way to bring change to a sclerotic system. It can't be evolutionary. It's got to be revolutionary. You got to do like what Milei's doing down in Argentina, where you're literally taking the chainsaw and just cutting off limbs and saying, look, we'll keep the body stabilized, but we just got to get rid of the gangrene. We'll cut first, and then we'll ask questions later. One of the things that they gave me some real personal hope that happened a couple of days ago is you talked about sustainable food production, right? And that's something that's important to me. On my channel, I've interviewed Joel Salatin. I don't know if you know who Joel is, but he is basically the face of sustainable farming in America. If you've watched documentaries like Food Inc., if you've read books like The Omnivore's Dilemma, Joel is very prominently featured in those. And, up until now has been kind of a fringe voice, in my perspective, a voice of sanity in terms of how we can improve general U.S. health by eating better and raising animals more humanely on a way that treats the soil, builds soil rather than depletes soil, and all the things that you'd want your food production system to do. Anyways, Joel just got tapped to be to take a role in the FDA.
Wow.
And I mean, that never would have happened. Never in a million years would have happened with any other previous administration. The fact that they're reaching out to voices like Joel to come in and have a say at the table is incredibly inspiring. What's going to happen? No clue. But the fact that we're beginning to see disruptive steps like that I think are highly disruptive, but a step very much in the right direction.
Yeah.
I think is the kind of change we need. Now, I think it's probably a baby step of a marathon, but at least we're starting to take steps that we weren't even thinking about taking, as of a week ago.
Yeah, I think, and bringing all that to light. I mean, I think, and RFK's done a heck of a job of doing that as well. I mean, I think that's one of the big things that,
I'm pretty sure it's because of RFK that they're pulling Joel in, but yeah.
Yeah. Yeah. And you know what? I mean, and these are what you just said. I mean, these are things that we can do as a society of Americans. I mean, you and I spoke about this before we even got started about being healthier, working out. And like I said, I would love to see more food production here in the U.S., good organic food production. That will keep us healthier as well. And then to bring manufacturing back.
Right. Well, and create local jobs and make our food supply more resilient. There's just 1,000 reasons to do it. Let me make one other comment real quick, because it came to mind as you were talking there. Apparently one of the most successful political ads for the Trump campaign was kind of pushing back on the pronoun, basically on wokeness, and it used pronouns to do it. And basically the punchline of the ad was, Harris is for they, them, Trump is for me and you, or something like that. Right. And I think going forward, for the types of changes that you and I are talking about, that the country really needs to embrace and pursue, we need to have a shift of pronouns from it's not about me, it's about us. And I know that sounds kind of socialist, but it's more, think of more like the greatest generation pulling together, right? There's important things that we have to get through as a society, right? We need to rise and defend democracy. We need to help each other get through the Great Depression, right? There's a strong sense of we're pulling together in national unity towards a common good and something that's, going to take our energies over time to make happen, right? That old saying of, what is it? Hard people make good times make weak people make bad times, right? And what happened is the greatest generation laid the foundation. And then we, by the time the boomer generation came along, and not trying to slam your generation too much, but what was it? It was the me generation, right? It was all about, forget about, the cultural norms and demands, and, it's all about me. And I think that's in many ways become even more self-centered in the digital era, right? And I think we need to get back to a cultural sense of, what is the greater good for society, and what is my role to play in helping make that greater good happen? Because like I said, it's gonna take real pain and real sacrifice. There is no magic pill. There's no magic law we can sign that all of a sudden makes everything better tomorrow, and we don't have to pay for the hole that we've dug for ourselves. We're gonna have to pay the piper. So, let's get a leader who can craft a good path. Let's get a populace that elects the right people to support that path, and then plays an active role in saying, yeah, I'm going to, I'm going to make the adult decision to say, I'm going to, shoulder whatever my individual burden of this is, so that tomorrow I and my future generations can benefit from this sacrifice.
Yeah, no, that's all good points, man. I hope he can do it. We'll see.
We'll see. And look, to be clear, I'll be throwing slings and arrows at him as I see him doing things that I don't like, because I'm sure he will to a certain extent. But that's our job as impartial viewers, right?
And I think the big thing here, Adam, is that, regardless, of the outcome, I think, as you said, it's very important if we're going to survive as a society, not just survive, but excel, fix things that are broken, that we want a better life for ourselves. We are going to have to find a way to be unified. And I don't think, and what I hope is that, that the message, for the most part, is that people do want betterment for themselves and their family and their future. And I think that that's the focus, because look, these officials can only do so much. I mean, they're great at screwing things up. I mean, Reagan said it best, right? I mean, the last thing you want is the government to show up saying they're here to help, right?
Right.
So I think that, I hope everybody can come together once the smoke clears and put their heads down and dig out from this and turn this country around into the direction that it needs to be heading in. And, I hope we can find a way to do that. Let's talk about our jobs, because, and I know you corrected, the statement about 100 million jobs or people, Americans, that, you've boiled that down. I do want to talk about that, because what we've spoke about with inflation and the demotivation that many are feeling, and the mental illness that we're dealing with in the country, I feel a lot of this is related to the direction that we have been going down over decades here in the country. So when we talk about the jobs, when we look at the wage growth, it hasn't, obviously the flip side of having deflation would be we need wage growth. And that in itself is inflationary. But what do you think that when Trump says that he's going to raise wages, how can he do that without bringing onshore, reshoring jobs, creating new jobs, slowing down or eliminating AI that could be so disruptive to our jobs?
Yeah.
When someone is looking at trying to get a job and sitting on the couch or in their mom's basement or what have you, and they're offered a job that does not pay them enough to get them off the couch or out of the house, what's the answer to something like that?
You're giving me all the easy questions today. I mean, this one's hard. This goes back to kind of, the pain that I was talking about. It's going to kind of be, I think, in the middle. I mean, look, I don't know for sure, but I think at the core of everything Trump's talking about is growth, right? I'm going to do things that stimulate growth. And look, growth is good. And the more growth we have, not only can the existing companies pay their employees better, but the more growth we have, the more other companies will spring up, and we'll have more competition, and we'll have more positions at more companies for people to apply to, right? On the flip side of that, one of the reasons why people are able to stay on the couch in the basement is because there are assistance programs, government assistance programs that are enabling that. Right. And I think this is going to have to end up being kind of a carrot and stick, right? Where, I mean, one of the dangers of where we are right now is we've had this cohort that I mentioned, this 10 million sort of plus. A lot of those people have been checked out for a decade or more. Like when you've been out of work that long, not only do you not have a resume of skills to point to get hired, but just kind of your working skills and mindset is atrophied, right? And there's a good question of like, are some of these people ever going to be employable again? And I'm not trying to denigrate them. I'm just saying, just like if a person was laid in a hospital bed for 10 years, they're not going to get up and, join a sports team the next day. Their muscles are too atrophied. So we have to, provide more opportunity, right? So that these people can earn a living wage and things like that. But at the same time, we also got to turn up the heat a little bit and say, look, you can't have the never ending benefit that allows you to be permanently checked out, right? And that's going to be painful, right? That's going to be some pain, but I think it'll have a net, if we can do both, we'll have a net future good outcome. And we talked earlier, I mean, it's not going to be this simple, but we talked earlier about the impact of deportations. In theory,
which is not going to be cheap.
It's not going to be cheap, but in theory, if you could deport 10 million people who you think shouldn't be here and replace them with 10 million people who have not been productive, but are working age and have the ability, and you just do a swap, that would actually be a real net good benefit for the American economy and society. Again, it's not going to be that easy. It's not going to be that clean, but we have got the potential to be able to do it.
What about immigration? What's the answer to legalizing the illegals? And I mean, we are dealing with a population decline.
Yeah.
I mean, people are having less kids.
Yeah.
So how do they, how do you take these people out of these jobs? I mean, I guess that's what you're saying. It's going to be a lot of pain. I mean, I would see that there's, number one, a lot of these people that don't work maybe don't want to work.
Oh, you mean the 10 million that are checked out? Yeah. They I mean, a lot of them don't. I mean, almost all of them don't. I mean, because if they did, de facto, they would find a way to be in the workforce for the most part. Although a lot of them are, like I said, understandably very demoralized. I tried. There was no job for me. I'm giving up. But let me get to your question about immigration. Immigration is essential if we want our economy. If we want to keep our current economic model, it's dependent upon an ever-growing number of people in the 25 to 55 age range, right? And that has been shrinking, right? So we need to get that headed in the right direction again, and we're not going to do that at current birth replacement rates. Now, another conversation we could have at a different time is, hey, what could we do to basically, if anything, get the number of domestic births up? But putting that aside for a moment, immigration is what's going to need to fill the gap. And, as we've talked about, and we've talked about this before, there is no shortage of people that want to come into the United States of America. As Elon Musk says, our border is not with Mexico and Canada, it's with the world, right? So I'm personally a big fan of a term I'm hearing more and more of, high walls and wide gates. Right. So make it a lot harder for people to get in here illegally, but make it a lot easier for people to get in here legally. Right. And so, I did a really fascinating deep dive into the topic of both legal and illegal immigration on my channel. If anybody really wants to get like immersed in the facts of it, I highly recommend you go and you listen to that. You can just go to thoughtfulmoney.com/immigration. It'll take you straight to that video. And one of the interesting things about the legal immigration side of things is we're not doing a great job of that right now. And one of the things we're doing a really poor job of is recruiting the skills that our economy needs when we're bringing people in legally. And I think we just need to get much, much, much better at that. I hope that's a big focus of the Musk Department of Government Efficiency and things like that. If we can stop the stream of illegal immigrants, but then get much better at recruiting the talent that we want to have for the type of a future economy we want to have, we turn what right now is a big liability into a gigantic geopolitical advantage for America, right? So I think, with good policy that's then implemented effectively, again, we can turn something that's been a massive distraction for us into one of the greatest jewels in the American adventure.
I completely agree. I want to read a couple comments from our last video, if that's all right.
Absolutely.
It really it struck a chord, and the video, you guys can check it out. Adam and I, it was about a month ago. The last video that we did, we spoke about sort of the obviously pre-election, but the state of our workforce. And someone had commented here, the population of the U.S. right now is around 345,426 and some change million people, including children and people that fall under senior citizens. In other words, more than a third of the population of the U.S. It's beyond incredible. And by the way, this is on the Bureau of Labor Statistics, the almost million, people that are, in the country that aren't working. This isn't a number that you came up with, Adam.
Yeah.
It's beyond incredible. I knew that it was bad, but it's insane. I'm on Social Security at 77 and a half, which means I fall under really old. I'm better off than a third of the people in the U.S. What? My minivan is 25 years old and working fine. My house is 100 plus, getting younger with home improvements every year, slow and steady. I joke, but I feel sorry for the children. What future is that?
Yeah, I mean, I feel the weight of that person's comment there. When they started, I'm doing this number from memory, so I'm sure it's not exact. But when they started Social Security, Todd, I think we had like 20 or 30 workers to every retiree, and I think it's now down to something like 2 or 1.5 or something.
The problem is they've tapped into it for not just retirement accounts. I mean, it's disability.
Right. But the point is if you are the younger generation, right, and you're just starting out in your working career, like you're already shouldering a much larger burden of the people who came before you than previous generations had to. Right. So, we add to this like I said, the third of U.S. adults that are considered outside the workforce. So just to be clear for folks, when you hear the unemployment rate, when they tell you it's 4% or whatever, they are not including that 100 million. They are not including that third of the U.S. population in those calculations. So that is, and again, I'm not denigrating these people, but that's just a tremendous amount of dead weight that is not even being factored into the official calculations, but it's certainly factored into your real life and your real burden of what you have to do to carry this economy forward.
To the tune of 15.3% of your income is going to FICA and Medicare. It's 7.65% times 2. As an employer, you match it. So every, dollar that is earned, or $100 an employee earns, 7.65% of their up to, I think now it's like, I want to say like 168,000. They keep raising the ceiling on it. So if you make up to $168,000 a year, I think that's what the number is. 7.65% of your money is going into Social Security and Medicare. Your employer is matching that number. So it's costing them to have you on the books, 7.65%. 15.3% of your money, it's your money, whether it's the employer paying it or you paying it, it would be money that you would otherwise be able to collect had the employer not need to match that. is going to Social Security, and that's not enough. It's in such a deficit that it's the number one expense, I think, on the balance sheet of debt, of obligation, of cost for the federal government, Social Security. I mean, that's crazy.
And let me just add on to this too. I'm trying to remember who I was interviewing, and I may be misattributing this to Peter Atwater, though I think you would probably agree with it, is, there is a big wealth transfer that goes on in society to the haves and the have-nots. So there's a class division, but there's also a big age division too, which is the economy is largely run for the benefit of older Americans. Right. And the argument for that is first off, we talked about everything that gooses financial asset prices, right? Or asset prices in general, right? Who owns assets? Well, it's predominantly the older generations, right? So anything that gooses those assets benefits them way disproportionately. Now, to your point, when you look at government spending, by far, the three biggest expenditures of the government by far are national security, healthcare, and Social Security, right? Two of those you only get if you're over 60, right? So you only benefit from if you're over 60, right? So when you look at our policies that are driving up asset prices and our spending, which is going disproportionately to these other things, they all go to people largely in their senior years. So, again, for that and many other reasons we discussed here, like it's understandable why the younger generations are feeling increasingly demoralized right now, because, they're also being told, hey, you got to shoulder all this, or you got to work extra hard compared to generations that came before you. And by the way, you probably may not ever be able to afford a house or maybe able to afford to start a family. So again, not a huge surprise why these people are increasingly frustrated.
And to your point, another comment from our video was many people in their 50s who could still be working are required to care for their elderly parents because the social safety nets of their retirements have disappeared and the medical industrial complex won't work for them to get them healthier and more self-reliant. Elders have become the new cash cow for a sickness model rather than a health model.
I mean, it's hard to disagree with that. And of course, that's RFK's, big thing here, right? Is, our healthcare system is metastatized into the sick care industry, and it's all about, treating symptoms and keeping people from, deprioritizing prevention and things like that, because there's just so many profits to be made in the treatment of all this stuff. Yeah.
And Adam, I have one more for us here. I disagree with the idea that of those young people don't want to go to work. It's offensive in many levels. I personally know many of them, including members of my own family, who have been applying for many dead-end jobs or so-called ghost jobs, only getting rejection at 12 midnight. I have seen the frustration when companies play games and interviewers using actors of themselves. It's time to ask companies to do the right thing and stop playing psychological games for metadata.
Yeah. I mean, look, I feel this one too. So I've got college-age daughters, one who just graduated college, and I've seen firsthand through them, as well as just through other people I know as well, the personal anguish and frustration of getting out there and trying to get hired in what is being billed as, a strong economy, a great jobs market, right? Powell was talking forever about, there's so many more applicants or openings than there are job applicants. And probably more than any other data that's been hard to believe from the government over the past couple of years, the jobs data has been the one that's been the hardest to swallow. And of course, Todd, I'm sure you talked to your viewers here about how they finally revised the payroll numbers down by like over 800,000 a few months back, right? Basically admitting, we've been
a couple of jobs.
Yeah. Just basically admitting we've been way overstating this stuff, right? So, again, I think we've talked about this in the past, but it's worth noting for folks. It's not a great job market, no matter what we're being told. And if we look at the data, right? The jobs market, the trajectory is weakening. Now, again, if you look at the official data, very little of it is in, code red stages yet, but we're not entirely sure how much we can trust it. But if we look at the trajectory, initial and continuing claims are starting to rise. The employment rate has risen, right? And as we've talked about in the past, when you look at the historic chart of the unemployment rate, what it does is after a recession's over, it starts plummeting, the unemployment rate. And then it comes down and it forms a base, and it's very, very quiet. And then as soon as it starts increasing, generally, bam, it spikes up and we go straight into the next recession, right? And that's been pretty much the pattern for almost every recession in living history here. And so, you have to ask yourself, hey, if the unemployment rate's starting to creep up, what's going to keep it from doing that this time? But my point there, Todd, is sadly, this person's right. It's hard for a lot of people, especially those with lesser skills, to crack into getting gainful employment right now. Automation, AI is going to make that even harder for folks going forward. But also, if we go into the natural order of things, where we go into another recession at some point, that unemployment rate is going to go an awful lot higher. So my point here is as frustrating as it is right now, it may get a lot worse for those people before it gets better.
Yeah. Well, Adam, we have a lot to go over, obviously, in future conversations, how this thing plays out. I mean, we want to stay positive and hopeful, and I think that we will.
Pretty heavy. I hope we didn't make too many people put their heads in the oven here. There is room for optimism.
I think probably the exact opposite. I mean, we've given some great inspirations of hope in here, things that we need to do. We have a new year coming in 2025. And I hope for the American people that they start to focus more on themselves and not so much on, what other people think they should be doing. The fear of missing out needs to be put away forever. I think that we need to be realistic with what we can afford. We need to start doing things that are good for ourselves. Stop excessive spending on things that we don't need. If we do that, and our administration can start to make change for the better for America's citizens, it will come together for the good. That's what I'm praying for, Adam. So,
well, I pray for the same. And if I can just add on your thing there, two things. One, Todd, it'd be super fun to come back on the channel at some point and really roll up our sleeves and just talk about solutions, right? Like at a personal level, what are things people can do to improve what are they doing odds for thriving here? Yes. But secondly, to your last point there is, I would really encourage people, especially now that we have a new administration and it looks like there's a lot of change coming on, no matter whom you voted for, get involved, right? Find momentum that is building towards a change that you want to see, and just find ways that you can get involved in that. Because at the end of the day, that really is going to be an essential part of the solution. Is the public is going to have to step in, like I was talking about earlier, and really own its destiny here. And that's going to largely be the addition of a lot of individuals, getting involved, and then collectively, we'll all become more so over time. So highly recommend, again, whether you voted for the incumbent or not, I'm sure you can find something going on that you can say, look, that's going to make tomorrow better in some way that's important to me. What can I do to help that out? One last thing too, before we wrap up, just because I want to scratch this itch if people have it. So we were talking earlier about the markets and whatnot, right? And I think if I didn't answer enough for people wondering, hey, what should I do in this this moment where everything is overvalued, I'd highly recommend you follow Todd's advice there about not getting taken up in FOMO, because I think that's kind of beginning to be what's going on right now, certainly in the markets. And I can't say whether this is going to prove to be ultimate FOMO or not, but it certainly seems to be happening in Bitcoin right now. And I can imagine a lot of people who have, been worried about the system, seeing the S&P blow through 6,000, and they're now beginning to hear people chat about, well, what about 7,000? What about 10,000? I would caution people from jumping on board because of emotion of being left behind here. That's exactly how market peaks operate, is they force the people who are on the sidelines to capitulate, at the worst possible time, and then they pull the rug out from under them. Are we going to hit S&P 7 or 10,000 in the next couple of months or quarters? I don't know. Anything's possible at this standpoint. But if you look at valuations, right, if you look at like the GDP, the market cap to GDP extreme that I showed earlier, we know that there's a lot of grains of sand on that pile now. So we can't say which one's going to collapse it, but we can say we are closer to the collapse than we've been before, right? So I would say this is a time to not get caught up in emotion. If you want to play, and still be long this market and try to, get some upside, that's fine. That's your call. I'd advise people, ask themselves, is this a really good opportunity, or am I just chasing, picking up nickels in front of the steamroller, right? That's, you don't want to be the guy doing that. You can still get a pretty good return sitting in something safe, like short-term treasuries. It's not sexy. It's not going to go up, by double digits in a given year, but it's going to give you a safe, and right now real return. If the market does go through some correction, you'll then be in the enviable position of having some dry powder to deploy at better valuations. So, my big thing here is like, just don't get caught up in the emotion. If you want some help here, talk to a professional financial advisor who understands the issue that Todd and I talk about here. And to be clear, there aren't a lot who do, but if you've got one who does, great, stick with them or find one who does. That counsel can be really, really valuable, sometimes invaluable in helping you make, some of these mistakes that people emotionally make at the end of a big market run up like this. Also, too, we're coming in near the end of the year. And if you don't feel like your portfolio if you're not feeling it's really confidently well positioned for 2025, maybe get an expert's opinion on that. But most importantly, just prioritize safety. Don't do anything that, if your thesis is wrong, is going to put you in a hole that you can't recover from, especially if you're older.
Yeah, great point. And you can help people with that too. And all of your links are in the show notes. And, certainly if those of you who don't know Adam Taggart, I don't know where you've been, but I'm sure you're out there, you exist. And we're going to just say right now that check out his links below, subscribe to his Substack, subscribe to his channel. And if you do need that assistance with, some level-headed, common sense moves, reach out to him as well.
Thanks so much, Todd. For folks that are looking to talk with an advisor, just FYI, I'm not trying to talk my book here, but if you want to have a free, no strings attached, no commitment consultation with a financial advisor who takes into account the macro issues that Todd and I talk about here, just go to thoughtfulmoney.com. There's a short form there. It takes you like less than a minute to fill out, and you can have one of these free consultations. Do whatever you want with what they tell you. But Todd, I do. It's important for me to say here at the end that it's always a pleasure and a privilege to come on your show. You're such a wonderful guy to talk with. I love the fact that we have really meaningful conversations here. It's not just about the data, but it's about what does this all mean and what are we all hoping to get out of here? How do we make sure that the viewers here are making decisions that will help them have a better future? And I got to say, the people who come over to my channel from this one are just wonderful. They ask great questions. They are the exact type of people for why I created Thoughtful Money in the first place. So it's both a joy and an honor to be able to come on your show.
Thank you so much. I feel the same way about you. I really do. And I appreciate our friendship. So as always, guys, you can expect that you will see more of Adam on our podcast. And Adam, we'll talk to you next time.
All right, buddy. Thanks so much, Todd.
You're welcome. Thank you. Hey, thanks for making it to the end of the video. If you like the video, you can let Adam and myself know by hitting that thumbs up. And by the way, it does help heat up the algorithms to send it to more people. If you haven't already subscribed to Sachs Realty's YouTube channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. I always enjoy reading your comments and questions. You can drop those below, and we'll see you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.